The Bank of England can breathe a sigh of relief. It looks like the US Federal Reserve will raise rates this year after all. Fed Chair Janet Yellen repeated today that the Fed was on course to hike, so long as the economy performs as expected. The main effect was to boost the dollar, which rose against all the major currencies, although bond yields barely rose and the futures market only marked up the odds of a rate rise this year back to 50-50, having previously been factoring in a slightly more dovish view. Now, all this matters to the Bank of England because, despite of its much vaunted independence, it might as well just outsource its monetary policy committee to Washington for all that the market cares about its ability to set rates appropriately for the British economy. Now, there are, of course, some fairly tight links between the UK and the US when it comes to growth and investment, although Europe's much more important for British exports. But while inflation moves differently in the UK, you can see the blue line here in this right-hand chart is the British inflation and the red line is US inflation. The bond markets just don't care. On the left, you've got, again, the UK in blue and the US in red for gilt yields, 10-year yields for gilts against treasuries, and you can see that really they move extremely closely together, and recent years have become even closer. And partly this is because gilts are a solid, globally traded reserve asset treated by investors as all but interchangeable with treasuries in many respects. But partly it's because the overwhelming importance of the Fed as the central bank for the world's main reserve currency leaves the Bank of England little scope to ignore what the Fed's up to. Britain, after all, is a relatively small, open economy. Now, the bank hates this idea. Yesterday, David Miles, who's about to attend his last rate-setting meeting early next month after 6 years during which he hasn't ever voted to change rates, insisted that the bank won't and never has just followed the Fed. In fact, he went further and said this was a daft idea. Well, that's at least what he said. But there is a suspiciously close connection before the Fed setting off on a tightening cycle and the Bank of England following suit a few months later, as you can see here, with the bank base rate shown in red. We've switched the colours over from the previous chart. Now, only once back in 2003 did the bank start its tightening cycle ahead of the Fed, and you can see that the bank ended up pausing it and in a sense waiting for the Fed to catch up. Now, there was a brief period a year ago when the markets had decided that this time might be different, and short-dated bonds prepared for the UK to raise rates before the US and to raise them faster. Today, we've had reported the fastest rise in pay in 5 years, which adds to the signs that it might be time for Britain to have tighter monetary policy. Even Mr. Miles was making hawkish noises ahead of his final vote. Those prepared to bet on central bank independence from the Fed will be heartened by Canada's decision to cut rates today after its economy was hit hard by the oil price fall. After all, Mark Carney ran the Bank of Canada before becoming Governor of the Bank of England 2 years ago. And Canada's economy is far more tightly bound to the US by its exports than Britain's is, even if Canada has much more reliance on raw materials, which of course explains why it's struggling. Still, so long as Miss Yellen follows through and raises rates, the Bank of England can stick with historical tradition and follow suit shortly afterwards, as traders almost universally expect.